Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
Welcome back to the High Rise, a laid-back, data-back conversation where we talk all things cannabis, from U.S. MSOs to Canadian LPs, products and market analysis through the lens of data. My name is Cy Scott with Headset, and I am joined, as always, by Emily Paxia of Poseidon.
Hi, everyone. Welcome to the High Rise.
And today we have a very special guest, many-time guest, almost in the five-timers club here at the High Rise, with Matt McGinley, Managing Director at Needham, covers the cannabis space. Thanks again for joining us, Matt.
Happy to be back, and thanks for having me.
Yeah, I can't believe it's been 3 months already since we had this last conversation. Time sure flies. And today we're going to dive into, those organizations that have announced earnings, that being GTI, Curaleaf, Ascend Wellness. But before we start, I'd love to hear your perspective just on the macro view in the industry and what's going on right now.
Yeah, so the big picture here, the big factors that are impacting demand are, kind of roughly aligned with what we spoke about last quarter, but I would say most of those factors have probably gotten a little bit worse from when we last did this in November. So big picture for the overall industry, like the industry is roughly $25 billion in total revenue. It grew around 30% in 2021, and we expect that industry to grow around 15% this year. That's still a very healthy pace of growth, and most industries would envy that level of growth. But over the near term, the industry growth has been somewhat tepid since last summer. The third quarter growth was flattish. The fourth quarter overall revenue I have down at around 2%. And with the continuation of some of those macro trends in the start of the soft start to the year in January, which I think was mostly related to store closures and disruptions related to Omicron. The first quarter could be down at a low single-digit rate. January always has a step down from December, just because December is just a stronger month. But like I said, late December and January were very soft. February trends looked a little bit better, but it might be hard to get back to flat unless March trends are really exceptionally strong, given that sales deficit that was created in January. Again, not insurmountable, but March would need to see about a 7% increase in revenue per day compared to February to get us back to a flat level for the first quarter. So not a particularly high growth rate sequentially for the past few quarters. And there are a handful of factors that are impacting that. The biggest is that we have had this resumption in more normal economic activity and consumer behavior. Consumer spending on services has really increased for the past few quarters. 2020 and 2021 consumer spending was largely driven by things that people were, enjoying at home. They were buying furniture and home improvement and alcohol and toilet paper and cannabis, apparently. And now the spending is kind of switching over, and there's a higher growth in services like, in restaurants and vacations. I wouldn't say it's a surge, but it's perhaps recovering is a better way to define it. But people have a finite amount of time and dollars, and on the margin, those dollars I think are being spent elsewhere. The cannabis industry today, it doesn't really have this big on-premise component today. So, consumption lounges are only exist in a few states. So to the extent that somebody says, let's go out on the town, there's a 99.9% chance they're not going to a consumption lounge. So, some of these shifts from at home to away from home consumption, some of those behaviors don't really benefit the cannabis industry much, if at all. Then the second big factor here is inflation. Now, a lot of that is tied to disruptions out of the pandemic, but we are now seeing a lot more inflation within energy prices are surging, and that's flowing through the economy. Consumers spending more on services, but they're also spending more on goods, and a lot of those goods are in limited supply, and they're in limited supply because of supply chain issues, and that's driven by port delays and chip shortages and things like that. But people are also spending more on those items, and demand has outpaced supply, which means producers are charging more. There's also fewer workers in the labor market. So you have a lot of older workers that left during the pandemic and they didn't come back. And then you have industries like restaurants and retail where, those jobs haven't really recovered. So as the cost of everything is inflating and workers are in high demand, they're generally demanding higher wages. And that's another component to inflation. And then, as I mentioned before, energy prices are very high. So production that was, turned down, maybe not off, but turned down into the pandemic has not been fully turned back on, and gas prices are up 50%, and groceries are up high single digits. And if you're in a household that's making $50,000 a year, and average hourly wages, I think in the February time period that was reported, they were up 5%, but the pace of inflation is up at around like 8%, your disposable income or your discretionary dollars is down for a lot of households. So that's, probably hurting the wallet a little bit. I would like to think that some of these fixes are going to be short term, but the way that the Fed would respond to persistently high inflation would be to raise interest rates. But because, if there's too much demand and the economy is running hot, then you kind of tap the brakes on demand with higher interest rates, which makes it more expensive for businesses to borrow and makes it more expensive for consumers to borrow things like homes and cars and all that. So as demand for those things begins to decline as a result of higher interest rates, that could cause some issues. But it's a very tight line to walk, because if you're raising interest rates and you raise them too much, you risk pushing the economy into a recession. And if you keep them too low, you risk that high level of inflation hurting the economy over a longer period of time. So there's kind of a lot going on with the macro right now, and some of these issues we're seeing right now in the industry are more cannabis specific, and some of them are macro related. But I'm not sure that some of these things are necessarily going to be short term. But specific to how this would impact the cannabis category, I mean, cannabis is generally a deflationary category, and in a category where your unit prices are deflating or decreasing, and all your production inputs like labor and rent and utilities and all those things are increasing, that's likely to have a negative margin impact. For the average one of these companies, you would likely see margins down on flattish top line and with all those pressures. Because the production capacity is still being built for this industry, because it's still a fairly nascent category. The cost to build a dispensary, the cost to build a production facility will be higher because the building material costs are inflating, which just on a dollar basis it's going to cost more, but that would also likely result in a lower return on those projects. So your hurdle rate on some of those things is now a little bit harder to get beyond. So yeah, those are kind of some of the big macro factors that are hitting this space right now, and that's these are factors that are impacting every industry. But like I said, with a deflationary category, it's a particularly acute situation for the typical MSO.
Yeah, and I'm glad you set the stage for that, because I think for us as an industry to ignore that all of the myriad ways that inflation and supply chain disruption can impact our industry we're just going to set ourselves up for heartache for what 1Q 2022 looks like. And so and I'm glad you really hit on the labor aspect of it, because that's something that I watch really closely in terms of, as a industry that as it expands, we have to add more bodies, and we're also trying to retain bodies. And every time you have to replace somebody, they come in at a higher point of entry. And same thing with every new market we turn on. And especially as we turn on new markets like New Jersey, where there is a really competitive job market, especially with all of the pharma and other product companies based out of that area. And we're competing with the New York metro area as well. So it's something we should definitely watch. I remember on the call, which we'll get to in a minute, but I remember you talking with Anthony Georgiadis, the CFO of GTI, about it. He certainly mentioned the employment aspect of this as something that we have to think about, because the human capital piece of cannabis is a huge part of our expansion as an industry. So I'm glad you set the table for that.
What were those growth rates you were talking about that we need to see in March? Was that about 30%? Is that what you're saying?
No, it would be, February has fewer days, and there's 28 days in February. Sure. So when you look at it sequentially, like February should have weaker sales than January. But if you look at it on the number of days, it had a nice recovery in February relative to January. And again, January had these, there were a lot of like dispensaries that just had to close and for, a couple days in January because, COVID ripped through and they, had to close the stores and things like that. So
right.
In February, there was a little recovery there, but you're still at such a deficit in January that March, it could make up for it completely, because March is always a sequentially stronger month. March will likely be the strongest month in the first quarter, and that's been true for some time. But March would really have to be pretty strong to get back to a flat level in the first quarter compared to the fourth quarter. So again, not insurmountable. It's likely to be flat or slightly down again in the first quarter compared to what we saw for overall industry revenue in the fourth quarter.
Yeah, it makes sense. I was pulling some headset data from last year, and 2022 is not 2021, and every market's different, depending on age of market and so on. But the growth from February to March is pretty good. Last year it was pretty good. Like Arizona grew by 29.6%. In California it was 22%. On the low end, Nevada was about 12.8%. Maybe it was, I don't remember, February and March last year, but maybe, still not a ton of tourism going through that area. So much of it's driven by Las Vegas sales. Maryland kind of lower at 13%, but those are the lowest. Otherwise, in the high end, you got Illinois 31%. So maybe, some of that will hold. Maybe some of these markets like Arizona won't be growing as fast as they were back in 2021. But let's see. Hopefully the numbers pull through in March for the industry.
I think the other thing not to ignore is the impact of Croptober, as the illicit market is still a formidable competitor, especially in the western states like California. And I do think we feel that the most in the very beginning part of the year, and especially in a time, like to Matt's point, if a store is closed because it's closed, it's not hard to just look to your left or right out here in California and find an illicit market distributor, so to speak. So, and I was actually looking at the categories that were kind of down, and it looked like flower was lagging a little bit, which is interesting because that would be the most competed category to an illicit market. I mean, obviously illicit market vapes are a big thing, and it's growing in other things, but the easiest illicit market product to get into people's hands is flower. So I just thought that was a little bit interesting when I was looking at the data for the beginning of this year.
Yep, makes sense.
So let's dive into the categories here, or not the categories, the companies, as we were talking about earnings. So let's start with GTI. I know the revenue grew a little bit, it looks like. How are we feeling about it? What did you see, Matt, in your analysis there?
Yeah, so your revenue did grow 4.6%. It was up about $10 million quarter over quarter. I would say the punchline in this quarter is that it wasn't a flawless quarter, it wasn't a boring quarter, and I wouldn't rate this as one of the best quarters that GTI has ever reported, but it was completely fine, and frankly is a lot better than peers in terms of the top line growth and the margin rates. And overall, I'd say still like at a very high level, Green Thumb has distinguished themselves with the consistency in strategy and capital deployment and execution, and that has resulted in more consistent operating metrics and financials, which is why, in my humble opinion, I still think Green Thumb is the best MSO in the space. But this did have a little bit of choppiness in a few of the metrics in the quarter. But like you said, revenue was up just under 5%. The retail business, which is around 70% of their total revenue, grew by 8% quarter over quarter, with most of that coming from new stores that were added in the back half of 2021. But their comp, or their same store sales, which is an important metric to look at for retail productivity, was down about 1% in the quarter. Again, not the end of the world to have a -1 comp, but you generally want to see rising productivity and not declining productivity, and they had a slight drop in their same store sales. And then their wholesale business, which is around 30% of their net revenue, was down around 3.5% quarter over quarter. And there were, clearly some softness in a number of markets, but they cited the primary cause of the decline in the wholesale as pricing. And that likely came from, a couple of states, probably a little bit in Nevada, a little bit in Pennsylvania, and probably Illinois a little bit as well. And they had just, done those acquisitions in the back half of 2021 in Massachusetts, and that exposure may have given them a little bit more exposure to price decline there. But as the market slowed overall, there was more product available and pricing dropped, and that seemed to have negatively impacted that wholesale business of theirs. Now, on the margin side, when prices are dropping and at retail and in that CPG segment, and overall unit demand is not all that strong, that will have an impact on gross margin. And GTI's gross margin, which had been fairly steady for a number of quarters in kind of that 55-56% range, dropped by about 260 basis points to 53% in the quarter. And then on top of that, they're adding stores and investing in corporate headcount and infrastructure to support the growth. And their core SG&A dollars grew at a faster rate than sales, so that pressured margin rate by about another 100 basis points. So overall, the EBITDA rate, which had been pretty steady for I think 5 or 6 quarters at around 35%, dropped by 350 basis points to I think it was 31% in the quarter. And because the rate of margin decline exceeded the rate of revenue growth, their EBITDA dollars dropped by around 6% quarter over quarter. So everything I said there sounds really awful, but it really isn't. But this was kind of a stutter step of a quarter sequentially. I'd say on the positive side, their revenue, and we are still thinking these things, quarter over quarter, because you're trying to measure the growth, as it occurs, because the asset base is so different on a year-over-year basis. But year-over-year, their revenue was up like 40%, their EBITDA grew like 20%. they're still rocking like a 53% gross margin. They're at 31% EBITDA rate. Those are all like really good. And that's good for a cannabis company. That's good for a retailer. That's good for a CPG company. There are tech companies or, highly franchised restaurant chains that would be envious and jealous of that sort of, margin rate. So, and none of those industries have, multi-year growth that this industry would have or GTI would have. The year-over-year numbers here are still quite compelling. The other thing here is the cash flow generation for GTI remains, very strong. Despite that little drop in EBITDA dollars, the cash flow generation actually improved. They did a $50 million in cash flow from operations in the fourth quarter, and they did $130 million plus in 2022 overall, which is good. And then, the building blocks are really all there for growth into 22 and into 2023. They acquired last year assets in Massachusetts, Rhode Island, Virginia, Minnesota right at the end of the year. The CapEx that they're going to spend this year will be at about a similar rate as what they did last year, and their balance sheet is in great shape. They have plenty of cash. They'll likely be free cash flow generative this year. So those are all very good things. On the negative side, we kind of alluded to this with the first quarter in the comments we made, but the revenue in the first quarter, I don't think it's going to have much growth. Pricing, from what they had said, seems to have stabilized, but like I said, January was down due to seasonality and the Omicron disruptions, and they don't really have any new markets of size that would have come online. They'll get a little bit from Minnesota, but there'll be a few new retail units in Minnesota from that acquisition, and they won't really have much production capacity, incremental production capacity that would come online in the first quarter. So, I don't think we'll have much top line growth again for them until probably the second quarter, which will be primarily driven by New Jersey opening. They do have production capacity coming online, but there's sort of this lull in that addition that could potentially help them a little bit in the second quarter, but that's really more of a back half thing. So the growth here in the first quarter, we may have another redo of this kind of quarter where things are about the same with limited growth and probably stability and margin rate and all that. But I don't think the first quarter is probably going to, I doubt they'll knock it out of the park.
Yeah. Interesting, the New Jersey call out. I think that's kind of a theme through some of these other operators about, where the growth is going to come from. It sounds like everyone's looking forward to New Jersey and the call out on pricing. And, you mentioned Illinois, maybe Nevada, kind of looking at that, like just looking at flower pricing. And it was like every market we see kind of some price compression, but also I think notably an increase in discounts just in the market going on. And I'm not sure how much that was reflected in like the earnings call or if they mentioned anything like that, but that could maybe be part of it too. You just get lower prices, higher discounting, kind of driving some of those factors.
Pricing was definitely a factor they called out, and I'm sure we're going to hear that similar commentary from a lot of the companies. That declines in pricing likely dented their rate of growth by a little bit. But I don't know. When I think about pricing, pricing will generally go down in this category.
Right.
Pricing is impacted by a host of things like illicit supply and changing form factors. But ultimately it's a supply demand curve. It's Econ 101. Think of this through big picture, like the West Coast markets where growing conditions are generally more favorable and licensing is more open. Your pricing is generally going to be lower. But in these Midwest and East Coast markets, there are generally, but not always, there's caps on the number of dispensaries that'll be in a state, or there are usually some sort of cap on either the number or size of production facilities. And as these new markets open up, these new markets are generally in the eastern part of the U.S. It usually takes about 2 or 3 years for that supply demand to become more in balance. And when that occurs, and it's occurring right now in a number of these markets that you mentioned, the pricing declines. That doesn't happen all at once. It kind of goes in fits and starts. It doesn't happen at the same rate across the different form factors. But with that limited license construct that exists in most of these newer markets, that will likely keep pricing higher than what you would see on markets that are in the West Coast. So even if you see this drop in pricing, it's not like I wouldn't think of that as something that's just like going to go straight into the ground. And I don't think we'll see pricing in New Jersey that looks anything close to what we see in like California or Oregon anytime soon. But in a state like Illinois, where they're still waiting on the next batch of retail dispensaries to be built because it's all caught up in litigation and people are building cultivation to service that, that's over the near term. Yeah, that's an issue that will cause a decline in pricing.
Yeah. Well, let's move on to Curaleaf. So where we left off with Curaleaf, 3 long months ago was they were moving west with the Trike deal when they acquired the Reef dispensaries, Nevada, Utah, Arizona, and it was described by them as immediately accretive to margins and cash flows. So let's dive in. Did any of that get reflected? What kind of highlights did you see from the Curaleaf commentary?
I mean, compared to last quarter, which was, not a particularly good quarter. So I guess we have to think about the third quarter, and that's not the quarter that they just reported, but here in March, but the quarter they reported in November. I mean, they did have some, company specific issues in the Northeast. They were certainly very promotional in the third quarter, and their G&A grew at a much faster pace than sales, and so they had a host of kind of internal and external factors that all came together, and they had this very soft top line growth quarter. That last quarter, the big, let's say, aha moment, but the big concern was their margin rate dropped by about 4.5 points. Now, the punchline in this quarter is that the top line growth, again, wasn't so hot, but they are clearly focused on improvements in operating efficiency. They were clearly less promotional overall. Now, the revenue only grew 1% quarter over quarter, but they basically recovered the gross margin that they lost in the third quarter, and they're back to the same level that they were at in the second quarter. And they kept their core G&A, under control. So EBITDA grew 12% on 1% top line growth, which is really good. And their EBITDA rate improved back to 25%. Now, that's still below peers, and still need to make, improvements of that. But some of the scary things that we saw in the third quarter, they clearly have gotten their hands around, and they're, on the right path there. And I'd say that if there's one very positive thing about the quarter here, that it shows that they're clearly more focused on efficiency improvements. And for the guidance for this year, they gave a decent amount of detail on how they intend to improve margin rates. And, even with the top line guidance that they gave, or the revenue guidance that they gave, I mean, they basically were able to give us, good detail on the key events that kind of anchored the midpoint of the guidance. The first being, that New Jersey is going to open up on May 1st, which that may be a little bit aggressive, but, probably at some point in the second quarter or maybe the third quarter, we'll get New Jersey open. And then they had that the Trike deal that you're mentioning that closed on, Trike would have been October 1st, but between the two, they had those two Arizona deals that would likely add about $70 million of revenue for them in 22. I'm sorry, now I'm mixing them up. There's the two Arizona Bloom, and the single dispensary they bought would be about $70 million in revenue this year. Trike would close on October 1st, and that would probably add about $30 million in revenue. But because those acquisitions are much higher margin than what they would have in their core business today, that would probably help them by about 75 basis points in their margin rate. And notably, they said that they expect to see sequential margin growth in every quarter this year, which is good, because as I mentioned before, they're still lower than where we'd like to see them. And then they gave a very detailed breakdown on what their CapEx spend would be this year. And they expect to spend about $145 million overall. About 80% of that would go into cultivation or production investments. I think they said it's Pennsylvania, New York, Florida, and then they're investing more in some of these R&D initiatives and some extraction technology. But they'll spend $145 million on CapEx. But more importantly, or probably most importantly here, they said that their cash flow from operations in 22 will cover the CapEx for the year. So at a minimum, they're thinking they'll do at least $350 million in cash flow from operations this year. And in all likelihood, they'll be free cash flow positive for the full year. And in my view, that's kind of being free cash flow positive is sort of the gold standard for these MSOs. It's important that these companies generate free cash flow, because if they generate free cash flow, they're not relying upon the capital markets, and they can better chart their own destiny, and they can invest those internally generated cash flows into new markets, and and shareholders don't have to worry about dilution and things like that. So there's a lot of good stuff that came out of this quarter that again, I think they're on a pretty good path. Now on the negative side here, their guidance that they gave for top line was probably conservative. And, I appreciate when companies give guidance, but take it for what it's worth, and they're likely conservative, and they're helping us frame expectations. And we generally want to see estimates that are going to be going up and not down. But I think that the guidance range that they gave was pretty achievable, albeit below what the street had assumed. But they guided to 1.4 to 1.5 billion in revenue. I think consensus was around 1.6, and they guided to an EBITDA rate for the full year that would be 28%. They ended last year at 24.6% EBITDA margin. So that 28% is a move in the right direction, but still again a little bit low. And then they gave some good detail on these quote unquote investment markets for them, which are a big drag on their margins. And their investment markets are California, Colorado, Oregon, Michigan, and then the international business that they bought used to be called EMAC, but I think they call it Curaleaf International now. Those in total were around a 7-point drag on consolidated operating margin. If those assets are roughly a quarter of revenue, that would imply that they said that their overall rate on their core markets, I guess, would be around 32%, and they're if all those other markets are 7-point drag, that would imply they're probably about a single-digit margin rate in every one of those states. They're making efficiency improvements in those states. Over time, they think that those states could get to a 20 to 25% margin. Even if they reach that desired end state, it'd still be a little bit lower margin in those states, but those states will likely also have less revenue growth. So that gap or that 7-point spread between, or the drag rather they have from those states would likely narrow over time, because Connecticut and New Jersey and New York and all those states are going to grow at probably a much faster pace for them than what they would likely get out of Oregon or Michigan or California. So all those are things to note, but there are a few kind of negative things still there in the quarter.
Great.
I just wanted to say this this was my favorite quarter from Curaleaf. I was like, I feel like they're finally getting it really dialed in. I know Boris had massive aspirations for this business and did a lot of reaching early on and spending of resources, and I feel like they're getting it all tuned in. And I actually do give credit to the MSOs who do go into the more competitive markets, because it is a little future facing of what other markets can look like someday. And so I know it's a bit of a drag, but I think it's a good test to operating within those structures of California and Oregon, and how competitive it is, and the lower margins that you can see through those experiences. But anyway, I thought it was really interesting. And as a person who looks at this as a shareholder, I thought about how GTI and Curaleaf are set up to get through what I think will be. I happen to agree with you about what we think we'll see in 1Q 2022, and I think both companies are set up to get through just fine. And I like your point too about using the free cash flow to be able to continue on the CapEx instead of having to raise additional capital, because we don't know when this market's really going to turn around and how expensive raising capital could be. But they do have both companies have a really strong balance sheet to keep going. So good things all around, in spite of just a little bit of a slower growth story right now.
So moving on to our last company to cover, Ascend Wellness. So where we left off with Ascend on our last conversation was them mentioning slower growth rates in the first half of this year, given New Jersey delays and challenges to scale our wholesale business and licensing compliance and so on. So how is Ascend looking?
So Ascend is a little bit smaller in terms of the footprint. They're a newer public equity that didn't go public even a year ago. They're in 5 states now, and they'll be in 6 if the litigation regarding their MedMen acquisition of their New York assets is resolved in their favor, which we think it probably will be. But they're in 5 states, but I would estimate that probably 75% of their revenue comes from Illinois. They operate, I would say, a reasonably scaled operation in each one of the states where they have assets, and where you can see them really building scale right now is in Massachusetts and in New Jersey. Their retail productivity, which I define here as the amount of revenue you produce per box, is exceptional, albeit on a very narrow footprint. They only have 20 dispensaries, but they do really high productivity. And I would say this company is probably one of the better ones in terms of giving details on the drivers of the business, and the management. It's pretty candid in terms of outlining the opportunities as they see them, but also highlighting the risks that they might face. And when they reported the third quarter results in November, they were very, very open about highlighting that they were seeing issues in a few of these markets, and they revised their full year guidance to reflect those trends. I would say the quarter overall was, kind of in line with what the consensus had assumed, frankly, because they set expectations well with their guidance. But, the quarter overall, while in line, was soft, and they expect no real improvement in either revenue or margin rate in the first half of the year. So as far as what happened in the quarter itself, the retail business, which is probably about 70% of their revenue, did pretty well. I mean, the retail revenue was up around 2%. They called out increases in the number of transactions on the existing store base as being a positive. Did add a store in Massachusetts. I think that opened up in mid-November, and then they added another one in Ohio that would have been partial contributors in the quarter. But they noted that the basket size or the amount of spend per transaction was down a little bit, would have been a headwind. But about a third of what they sold through their stores was product that they had produced, and that is obviously a very high margin sale. So the margin rates, and they don't break it out specifically. We don't have the numbers around this, but they said that the margin rates in the retail business were actually up a little bit in the quarter. And as I noted before, I mean, their dispensary productivity is best in class, or like just under $15 million in revenue per box, which is really exceptional. And the retail business is overall, it's in good shape. Now, if that were the whole story, we could just stop there. But the wholesale business, not so much. A little bit of a different story. That was down around 27% in the fourth quarter. I'm sorry, no, that was 27% of sales, but the business was down around 23% in the quarter. And the two big drivers of the decline there were the wholesale market in Illinois and Massachusetts was weak in the fourth quarter, and similar to what GTI had said, they noted price decline in Illinois. But because they had ramped up staffing and production in their grow facilities in Illinois and Massachusetts, they had expenses that went up while sales went down. Expenses are going up and your sales are going down. That's not a good combination for profitability. So overall sales dropped 6%. And in gross margin rate, in the way that they present it, dropped around 390 basis points quarter over quarter. And EBITDA rate dropped by about 260 basis points to 22.3%, which is a little bit low, but not terrible. Still, 22 is still pretty good for a company, and that should continue to move upward over the course of this year. But on that, drop in margin rate and soft overall EBITDA trends, their EBITDA dropped by 16%. So again, broadly aligned consensus, not really a surprise, but not a great quarter from a margin and revenue standpoint. And then on top of that, the cash flow from ops was about a $19 million burn. $14 million of that was tax payments that they paid in the fourth quarter versus the second quarter. So, it's sort of a timing thing, and I wouldn't look at cash flow generation in any given quarter because there's a lot of working capital moves and stuff like that, and what you need to see is the consistent trend in cash flow generation. But this wasn't a particularly good quarter for cash flow generation for them. The other part of that drag was their inventory build, largely related to New Jersey and some of these new facilities they're bringing online, was also an investment that will probably unwind into 2022, but the cash flow generation was not great. Now into next year, the CapEx, they had guided to that to be around $30 million. The CapEx actually in the fourth quarter was a little bit more than we assumed, and I think that was a pull forward effect from projects that they had potentially thought that they were going to do in 2022, but their net CapEx was $88 million. I can't remember the gross was over $100 million, but their net CapEx was $88 million in 2021, and that will drop to around $30 million this year. Significantly less cash outflow related to the build of their asset base, and their balance sheet is in good shape. I mean, they had $150 million at year end. They'll get, I think, $22 million from sale leaseback proceeds of a New Jersey facility that'll hit in the first quarter. But if the revenue and margin are flattish as they had alluded to in the first half, there probably won't be a big amount of cash flow generation in the first half. But like I said, they're well capitalized to fund growth this year, and they could continue to acquire additional assets with their cash balances. Now, if that MedMen litigation is resolved quickly, they would probably have an outflow. They would have a cash outflow to buy those assets. If and when that would occur, they would be spending more on CapEx in New York. So there would be some cash need there. But overall, like with where equity prices are and valuation where it's at, like there's probably not as much to do with bigger M&A. They're still slightly into the caps for retail dispensaries in Illinois and Ohio. They could add another 2 dispensaries in Illinois, and they could add another 3 in Ohio. So those would probably be, the most logical things to kind of pursue. So there's still a little bit of M&A that they could do, and they could easily fund that with cash balances. And then the other thing that they noted on the soft trends is that they're, with that soft overall revenue trend in ramping operations in basically every state outside of Illinois, they are going to reduce their overall cost structure on the income statement by about $10 million over the course of this year. They think they'll realize around 40% of that in the first quarter, or by the end of the first quarter. And we think probably 3/4 of that will come from G&A, with the rest coming from COGS. So a little bit more than half of that's going to come from headcount reductions, with the rest from doing things like bringing more third-party services in-house and synchronization of IT platforms and things like that. But that $10 million is sort of a run rate for the year, but all in, that alone should increase the margin rate for the company by probably a few points this year. Key takeaway for Ascend was the quarter was soft, but broadly in line. Don't expect much growth in the first half, but the overall balance sheet is strong, and they remain in a good position to execute on their plan this year and into next.
One thing I noticed that I thought was interesting in your note was the 50-50-50 goal. 50% retail, 50% wholesale, and 50% of their retail internally sourced. You just mentioned about a third of what they sold was internal, so my takeaway there is a little bit off from that last 50%. Do you see that growing, or like that spread growing? Are they selling more of their stuff or selling less of their own products?
Well, their wholesale business took a step back in the last quarter. They moved in the wrong direction. So the 50-50-50 goals, they want to have roughly 50% of their revenue would be retail, 50% would be wholesale, and then half of what they would sell in their own stores would be product that they would produce. Now, I think Illinois caps you. I think you can't sell more than 40% of your own product in your own stores. So the fact that they have 75% of their sales are in Illinois right now means mathematically it would be impossible unless they got more growth in these other states to get there. But
or just break some laws one way or the other.
I don't think they'll do that, but that's kind of an aspirational goal. Directionally,
and it's a nice
you can see that moving.
50-50-50.
It's better than 40, 30, 20 or so. I don't know. Yeah, but that will likely increase over time. And really, when they have more cultivation that would come online in states like New Jersey, where there'll be they'll likely have a healthy wholesale program, and in Massachusetts, where they've done a cultivation expansion, that will likely have some growth there. But that 50-50-50 goal it's sort of a at some point in the future. But as long as they're kind of moving towards that path, it's good.
Sure. It sounds like, and the spread's getting bigger. Have there been any other companies that have kind of set this explicit goal like that? Like, we want 50% of our products to be internally sourced, or is this more of like an Ascend unique thing? And others may have that goal, they just don't talk about it.
Ascend has articulated that as a goal. I think most of the companies, if you look at the average MSO, they kind of look a lot like Ascend right now, where probably about 70% of the revenue is retail, and around 30% would be wholesale. Now, there are a few that, like Cresco, that have higher, Cresco is roughly 50-50, but the retail assets are faster and cheaper and easier to put up than a big production facility, and then building the whole, brands and all the distribution around that. It's harder, and it takes more time. But for most of these companies, you would likely see increases in the rate of wholesale growth to be faster than the rate of retail growth. Also, when you look at the number of available additional licenses to put up in many of these states, a lot of these MSOs really don't have, they still have unit growth, but it's going to be less than it had been previously. And so you would probably begin to see that retail as a smaller percentage of the total revenue. Setting a target for that is, I guess, to the extreme. You could say that you would sacrifice retail sales to grow the wholesale business, but that's kind of like, cutting your nose off to spite your face, whatever the saying is. So it would not be a fruitful strategy. But yeah, wholesale revenue would likely be bigger in the future for most of these companies going forward.
Sure, that makes sense. All right, well, that's everyone that's reported. This quarter is a bit strange. It seems to be a bit scattered. I think we have a bit of a preview of a couple more coming up soon, a couple that we covered previously, that being TrueLeave and Air. Anything that we should be thinking about with either of these companies, people should be listening for if they're dialing into these calls?
I think they both have kind of messy quarters, and there's some of the same factors we talked about for these other companies are going to hit them. But I mean, TrueLeave, TrueLeave will be particularly messy because they had the Harvest acquisition that they're integrating this quarter, and so there's just a lot of moving pieces around that. But if it were just for the Harvest acquisition, there'd be a lot of moving pieces on TrueLeave's quarter. But they have big exposure to Florida, and they gained exposure to Pennsylvania. For them, the fourth quarter is usually more promotional than in the third quarter. So even if the unit volume grew, the promotion would likely make the revenue negative for them sequentially into the fourth quarter. And then in Pennsylvania, they had a bad quarter in Pennsylvania, where a lot of their wholesale business just had some issues there. So their revenue, I think, will actually be down. And then the margins could be all over the place just because there's so much moving going on with the integration of those assets. But yeah, I think that'll be not a particularly good quarter for Trulieve. And the other thing is their three big markets now are Florida, Pennsylvania, and Arizona. I think all three of those markets probably don't have a ton of growth into this year. So that's just, I guess, something to think about, beyond the fourth quarter and the first quarter that they'll report. But I don't think it's going to be a gangbuster quarter for Trulieve.
Great. Well, we'll look forward to that and kind of hearing what they say sooner than later here, and maybe we can follow up after that. Well, moving on, I do want to touch on Canada. Feels like a little while since we've talked about Canadian LPs, but there was some news with Tilray acquiring HEXO's senior secured convertible note. I think it was about $200 million in debt, and they kind of call out getting it for the $20 million in interest, right? That they're gonna gain here. But Irwin Simon, the Tilray Brands chairman, said, quote, "For us, it provides a path for meaningful future equity ownership of HEXO and enables us to participate in HEXO's share price appreciation as it continues to execute on its growth initiatives. We also expect to realize further commercial and production efficiency savings of up to $50 million within 2 years." So it really sounds more about bringing these companies together, less around just capturing this $20 million in interest. It's quite interesting. I pulled a little bit of data on Canada, and Andrew Carter with Stifel actually did a really good analysis using some headset data and kind of talking about the 3 months ending February 2022. And just to kind of give, listeners a sense of scale. I mean, overall share of the Canadian market, you have HEXO at close to 10%, and you got Tilray at 6.7%. So combined, that's pretty significant. And then from a category perspective, what Andrew classifies as first wave products, those being flower, pre-roll, the stuff that Canada was allowed to sell in the beginning, and then next wave or second wave being beverages and edibles and vapor pens. But of the first wave, noticeable numbers in the pre-roll category, HEXO owns about 14%, Tilray at 9.2%. And that's the one category that showed a little bit of growth, but it wasn't much. It was only 1.2% growth, pre-roll in general, in Canada for that 3-month period ending February. On the flower side, and flower is majority of the sales that go to cannabis. It's not as good for either of these brands. You've got Village Farms in first place at 11%, Organigram 9.1%, then HEXO in 3rd%. So they're really not very well positioned on the flower side. And the second wave products, beverage in particular, I noticed HEXO really does do a pretty good job. They're about 34% of the market of beverages, and beverage grew about 2.2%. I don't think Tilray even showed up on that one. And then edibles, Tilray's in 8th place, and HEXO's nowhere to be found there. So kind of interesting how they're landing on this stuff, and the growth of their brands, like Tilray brands, not looking particularly good. Average across all their brands down about 20%. And it's getting called out, very competitive market out there. A lot of small operators still, taking market share when you add up all the smaller operators. So I think that a move like this seems to be very strategic, right? To get more scale, to try and weather some of this. But we'll see. We'll see how it goes. Just thought it was an interesting consolidation, future consolidation. It does seem like in Canada, you start to see a small number of players capturing a large amount of market share in other categories beyond cannabis. And so maybe they're trying to run that playbook. Will it work in this industry? I think jury's still out.
Was it Irwin who called the smaller operators ankle biters in 2020?
Yes.
Well, I guess I guess they're biting the ankles enough to make it matter, but...
Yeah, you could see where the frustration's coming from when, average sales for that 3-month period ending February is down 22% across the board for all their brands at Tilray. And I don't have the numbers handy in front of me for HEXO brands, but these are, Tilray brands like Good Supply and so on, that are under that brand portfolio just aren't doing particularly well. I think it's, very competitive market out there for them. That's a little Canada. And then the last thing in the news I saw today, did you guys see this? New York Times published that New Yorkers with marijuana convictions will get first retail licenses, reserving the first 100 or more retail licenses to sell marijuana in New York for people who have been convicted of related offenses or their relatives. So starting to get some news. Sounds like frameworks starting to be developed. I mean,
How
what
do
do
I
you guys
get
think
convicted is there a way to get convicted very quickly of a marijuana crime? Or can I'm not there yet.
That's
But...
a
Yeah.
lot of McKinsey, Boston Consulting Group analysts thinking the same thing, right?
Getting busted or throwing a joint on the cop's foot. That won't even get you in trouble in New York anymore.
No, it wouldn't.
Yeah. I mean, I'm happy to see an attempt at this. It's all going to come down just like it always does about the execution and the implementation of it. I hope they're going to think it all the way through because, as Matt pointed out at the beginning of these markets opening, it's, you got to get products on the shelf. And I just hope they're going to think this all the way through from, the product to getting it on the shelf. And with these 100 doors opening, I mean, I'm very in favor of this if they can execute on it. I think it is a good thing. And I think we need to all be taking steps towards this. But I know they were talking too about some funding resources around it, which will be necessary for folks with convictions to be able to access resources to raise money to get doors open. So that's a pretty important piece. On the face of it, very in favor of it, very impressed that they're trying to take such a bold stance, and it will all come down to execution and timing and being able to get this done. So I'm hopeful.
Yeah, it looks like it's $200 million is what they're proposing to help fund this. So yeah, that's great. Hopefully we see more of this, but it's great to start to see some news coming out of New York. I'm sure lots more ahead as the year progresses.
It would be smart. It'd be great to dig in on it, but what would be smart is if they engaged with the operators who have medical license there to help partner up with some of these groups on a funding standpoint. And then it's a beneficial supply chain unlocking of retail. So I don't know. I doubt
that's a no-brainer in terms of funding the working capital. I mean, the big challenge that a lot of these social equity applicants have in terms of getting operational, they lack experience in running these types of businesses, and it takes a lot of cash to start them up. So two key things that they can do is they can provide a lot of support and insight and show them how to run these businesses because they have experiences doing this across many different states. The second thing is that if they're producing before the program becomes operational, they can give them product to stock their shelves because these dispensaries have $500,000, $750,000 worth of product that would sit on the shelf in the average dispensary. So that's a lot of money. That's a lot of incremental money. And even if you jump through every hoop, then you're like the last thing is like, well, I need a bunch of money to stock the shelves. So it would be smart to partner with them because they could give, I think, pretty reasonable terms to them in terms of the amount that they would have to pay for that, or the terms and what they would have to pay for that to make sure that they, have the inventory to be able to, have a strong showing on day one when they open the doors.
I agree. Well said.
Absolutely. Okay, well, I think it's a great place to end the episode here. Quick heads up.
Let me read one thing. I want to remain in the good graces of my compliance team, so I need to read my equity research disclosures if I could real quick.
Absolutely, yeah.
All right,
Good job.
Here we go. Needham Company is an investment bank that generates revenue from investment banking services and might be a market maker in the companies mentioned in this podcast. Needham does not own any positions over 1% in any of the companies that were mentioned here. And I do not own, nor does any member of my household have any financial interest in any of the companies that were mentioned during this podcast.
Well said, and I'm glad you said it. I've had to say it on behalf of others in the past, and it's tricky. Yeah, so thanks for that. We will be back next week with some poolside sessions. Poolsides are back. Emily and I will be in Austin for South by Southwest, and I know a lot of great operators will be there, so we're going to take the opportunity to connect. So expect some more quick poolsides and more to come even next month. I think we've got some big plans. So if you happen to be in Austin to South by, please come out, say hello. We'll be on some different talk tracks and all of that. But as always, thank you for listening. If you're enjoying the podcast, be sure to subscribe, rate the podcast. It's a big help for us as we build our audience here. And Matt, thanks so much for joining us again. Your insight is invaluable. Yeah, so well done. So I certainly appreciate it. I'm sure all of our listeners would say the same thing. So thanks again, and looking forward to having you on again soon.
Great. Thanks for having me.
All right. We'll see everyone next time.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.